Good morning, everyone. I think we are live now. And welcome to today's webinar. My name is Guy Menon, and I am the Research and Knowledge Manager with Making Finance Work for Africa. Today's webinar objective is to contrast the performance of African local currency bonds against other asset classes. This is a joint initiative with the African Financial Markets Initiative, AFMI, and we would like to take this opportunity to thank the AFMI team for working with us on the webinar. I'm not going to tell you how important bond markets are during these uncertain times. Our experts from Standard Chartered and Mauritius Commercial Bank Capital Markets will share the knowledge on the state of local currency bonds markets in several African countries. Next week, Making Finance Work for Africa will host another webinar on the broader capital markets. But for today, we'll just focus on the bond market and specifically on the local currency bond markets. 231 participants have registered to today's webinar. Thank you for attending this webinar. We have a lot of materials to cover, so I will not take too much time. But before our panelists take the stage, allow me to quickly go over the outline of the session and also present the Making Finance Work for Africa partnership. After the housekeeping and Making Finance Work for Africa presentation, we'll have an overview of the African capital markets constraints and initiatives presented by AFMI. Then a brief description of the market landscape before a deep dive in the African local currency bonds market. A discussion will ensue, and then we'll close the session with I think in about an hour. Before we get started, I would also like to go over a few housekeeping items. The webinar will last a maximum of 60 minutes, including Q&A. All participants' microphones have been muted, and this is for your comfort. Questions can be submitted via one of the two panels on the chat or Q&A tab, or you can also simply raise hands to ask live questions. In case you're experiencing any technical issue, please send a quick request, and our team will be happy to support. Finally, slides and a recording of this presentation will be available after we conclude on Making Finance Work for Africa's portal. And also, please remember there's a survey at the end of the session. Thank you for filling this out and providing your input as to which thematic or subject we need to discuss for our very next webinars. This ends our housekeeping. Just a quick overview of Making Finance Work for Africa, which is a G8 initiative hosted at the African Development Bank. Our mission is to establish a common platform for financial sector development and knowledge sharing also in Africa. We focus on three interlinked strategic pillars: financial inclusion, long-term finance, and financial stability and regulation, with knowledge management serving as a cross-cutting pillar. Our donors, besides the African Development Bank, include GIZ, the AFD, Afrexim Bank, the European Investment Bank, the European Commission, and Minbuza, the Dutch Foreign Ministry. You can access thousands of news articles and publications on Making Finance online library, mfw4a.org. So this closes our brief presentation of Making Finance Work for Africa. Now, today's panelists, we are happy to have Marine Serre. Marine is Business Development Executive with Mauritius Commercial Bank Capital Markets. Albin Kaku, good afternoon, Marine. Sorry. Albin Kaku is a Senior Investment Officer and also is the AFMI Coordinator at the African Development Bank. Good afternoon, Albin. Samir Gadio. Samir is Head Africa Strategy and Research with Standard Chartered. Welcome, Samir. And finally, Abi Yadav. Abi is a Head of Fixed Income and Currencies with MCB Capital Markets. Now that we've done with the housekeeping and introducing our panelists, I'm going to turn over to Albin to provide a brief overview of the state of African capital markets. Albin, on to you.
Okay. Thanks, Guy, and hi, everybody. Thanks for joining us today. We have quite a full room, so I'm very impressed by the attendance. So I think before going into the details of the presentation, I'll give a quick background about the African Financial Markets Initiative. So AFMI was created back in 2008, and really what we're trying to do with this initiative is to promote the development of local currency bond markets on the continent. And why I'm trying to do that is because over the years, we have noticed that we have a growing pool of institutional assets that is available. And for us, really, the idea is to create the right set of instruments and the right ecosystem to be able to mobilize this capital and to deploy it towards our development agenda. So I think today I'll touch briefly on what the African local currency bond markets look like from a structural perspective, and then I'll dive into what AFMI is trying to do at the moment. So on the first slide, essentially, you can see that at the moment, the current local currency bond market amount outstanding is roughly around 430 billion USD. What is interesting is actually only 5 countries account for 80% of this amount, and this is Egypt, South Africa, Morocco, Nigeria, and Kenya. So we still have a further growth path to achieve. But when you compare to what the situation was back in 2006, you can see that actually we moved from 150 billion to 433 billion. And in terms of what our African countries are issuing on a yearly basis, we are north of 200 billion US dollars. We can move to the next slide. So in terms of maturity, the issue that we are seeing is that our African local currency bond issuance is skewed towards the short term. So roughly 75% of what our countries are issuing is below 1 year. And obviously, this brings a lot of challenges in terms of financing infrastructure projects that are usually long-term in nature. And when you look at actually the number of countries that are able to issue below the 10-year tenor, we only had 12 countries as of 2018. So all this data is actually part of the AFMI database that we are able to build thanks to our regular interactions with the different central banks and ministries of finance. We can move to the next slide. So the challenge that we see and that we're trying to address are summarized on this slide. So basically, as I was saying, yield curves usually are very limited in terms of tenors. So most of countries are actually not able to issue above 5 years. Yield curves are not really complete, and this actually is a huge challenge because typically those yield curves are traditionally used to price corporate debt and other derivatives. So this is usually the building block of any efficient capital markets. Then in terms of liquidity, even though the situation has improved in countries like South Africa, Nigeria, Kenya over the years, we still see some issue whereby investors, whenever they actually enter a position in local currency bond, it's very challenging for them to exit, and it can take them weeks in some instances. And when you look at the spread in terms of bid and ask, it can be quite wide in some instances. Some countries actually do not have the relevant ecosystem with very outdated primary dealers frameworks. And that's a constraint because those primary dealers usually are driving markets in terms of liquidity and animation. The issuance usually the issuance is quite irregular still in a number of, of countries. So at the FME level, we're trying to address all those challenges through regular dialogue and technical assistance. We can move to the next slide. So essentially, the way AFME is structured is we are built according to two pillars. I don't see if I'm not sure if the slide has moved. If can you move?
Yeah.
Yeah. So essentially, AFME is structured is built on two pillars. So the first pillar essentially is a knowledge management pillar, whereby, as I was saying, over the years we built this impressive network of central bank and debt management office staff disseminated across the various countries. So thanks to this data, essentially we've been able to build a very comprehensive database that is often used by the private sector and the asset management industry. The second pillar is actually the African Domestic Bond Fund, which I will touch about in the next slide. And the last piece is actually the technical assistance program that we are trying to do as part of the bank's financial sector development department. And for this specifically, essentially what we did is that we actually created the first AFDB's trust fund to provide technical assistance to capital markets. And a bulk of this technical assistance is actually meant to address the challenges in our regional member countries' local currency bond markets. So the second pillar of AFME is the African Domestic Bond Fund. Essentially, the starting point for this initiative was to actually provide kind of a matrix for investors sitting in Asia, in the US, as to what the local currency bond markets are able to generate in terms of returns. We can move back to the next slide. And actually, so it gives investors a feel of what the local currency bond markets are doing. So we actually teamed up with Bloomberg, the leading financial services provider, to build this index. So this index is actually a market-based index. We started with 4 countries: Kenya, Nigeria, Egypt, South Africa. After that, we added Botswana and Namibia, and finally we added Ghana and Zambia. So with these 8 countries at the moment, we are able to capture roughly 70% of the current outstanding amount of local currency bond markets. And the criteria for inclusion in this index really is liquidity of the local currency bonds. So liquidity, as defined by Bloomberg, is for each country. So the bonds must be regularly quoted in a consistent manner on the Bloomberg terminal. And this index actually also, so just so you know, we receive a lot of requests from countries that are not in the index yet. And what it does essentially, it brings a level of dialogues as to what are the measures required for them to join the index. And at this stage, thanks to the ongoing discussion that we had with few countries, I can say that the next countries to join the index in the next few months will be Morocco and Mauritius. So the index is available on Bloomberg. It has daily liquidity. And for those of you who want actually to follow the index, you can do so by going on Bloomberg and typing the ticker BADBC. So we can move to the next slide. So the second phase really of the initiative was to create an investable product out of this index. And the starting point of our reflection was to actually list what were the key concerns for offshore investors when considering investments into local currency bond markets. And when you speak to those investors, what you tend to see that is that liquidity is a huge issue. So liquidity, both in terms of spread and of being able to repatriate proceeds, access is quite a huge challenge for them. Transaction costs and the regulation. So with this African domestic bond fund, what we try to do is actually to create a product that will give relatively ease of access to African fixed income by actually structuring it as an exchange traded fund. So the fund has been listed on the stock exchange of Mauritius back in September 2018. And because we are not fund managers ourselves, essentially we outsource the fund management. So after a competitive process, Mauritius Commercial Bank was appointed fund manager of the fund. And I think Abby actually will speak later on about the performance of the fund. But so far, from inception, which is in September 2018, and mid-Feb, in a pre-coronavirus environment, the fund was doing quite well, outperforming all major asset classes. So I think we were up 21% since inception as of mid-Feb 2020, including a 12% dividend payments. But it's still doing well, and I think Abby will touch about the performance in a coronavirus settings, but we think we're relatively well. Last thing, maybe just so you know, so not only the FDB created the fund, but we've also invested up to $25 million into the fund. And we also, so as I said, the fund is primarily listed on the stock exchange of Mauritius, but we are actually considering other cross-listing in several African stock exchanges, and this is mainly to allow for local institutional investors participation. I think I'll stop there and maybe.
Okay. Thank you, Alban. Okay, thank you, Alban. What we can learn is that there's a trust fund for capital markets development set up by the African Development Bank along with other DFIs, and the ABABI index is available for everyone to follow, is growing, and also liquidity issues remain remains a major problem on African capital markets. Now, I think it's Samir. Samir, can you please tell us more about the African market landscape, but specifically in terms of country, what are some of the yields that you see, the trends, the currency issues, as well as maybe if you can touch also on the Europe. I guess you also have a couple of slides that you would like to go over. On to you, Samir. Samir, we can't hear you.
Can you hear me now?
Yes, we can hear you now.
Okay, right. Sorry about that. Okay, so I think, you all know the backdrop, right? So there was a significant market shock, especially in March, with investors de-risking their portfolios, given the sharp collapse in world economic activity at the time. We saw very large redemptions in EM local currency debt funds that obviously did have an impact on select African markets, which experienced very significant outflows. Just to give you a few numbers, South Africa had, I think, $3.4 billion of outflows in March. In Egypt, foreign investors' T-bill holdings fell by $9.7 billion in March alone, but I think it's $17 billion actually over 6 weeks. In Nigeria, same very significant outflows over the period. But if you look at the performance, it's a bit of a mixed bag because obviously initially, the markets that were the most open or had the highest foreign participation experienced these outflows. In some cases, the currency came under pressure, such as in South Africa, the dollar rand touching almost 19 at the height of the crisis. Nigeria had to move its official rate from 305 to 360, and actually the INE rate is somewhere between 380, 390 at the moment, given low oil prices. So you had an adjustment. But for example, take the case of Egypt. Actually, the currency didn't move, although reserves did decline, and presumably banks' net foreign assets as well. Now, what's interesting really is that even the yield backdrop in the region is somewhat mixed and nuanced. While you have these outflows in South Africa, for example, you had a significant backup in rates. So I think the back end of the curve went to as high as 14.2%. But the market was basically dislocated. You had a sell-off in Nigeria as foreign investors were unwinding their automobiles. But then actually, in both countries, for different reasons, rates fell over the last month and a half or so. And especially actually post-weekday exclusion in South Africa, where actually the market just realized that maybe the weekday passive investor exposure to South Africa was overstated. In Nigeria, the rates fell just because I think as foreign investors were out, basically there wasn't much pressure on normal rates, and the local investor base anyway has to buy local bonds. In Egypt, you had large outflows, but at the same time, very significant policy rate cuts. And so as a result, T-bill yields actually declined. I mean, they're backed up a little bit now, but they're certainly much lower than where they were before. To add to that, we've had significant easing across the board by central banks in the region. So, virtually, with the exception perhaps of Nigeria and Zambia, all the other central banks have cut rates. But as a rule, there's more liquidity in the system, access to refinancing has been eased, and so on. So what we've seen in a number of countries is a sort of bull steepening of the curve, where the short end has gained more as central banks ease, and because perhaps local investors are more inclined to buy short-dated tenors when it's available, not everywhere. Which is also quite interesting. Now, I think the key point really is what to do if you are, one, a foreign investor, and two, a local investor. I think if you're a foreign investor, it is a little bit challenging to get involved in local currency debt at the moment. And I think the reason is just that risk conditions across EM and across the globe have really not improved to such an extent that you could buy bonds or short-dated debt in countries where perhaps there's less liquidity, where there is FX risk down the line, where some convertibility issues could arise or have started to emerge. Another thing is that for investors who can be in both local and external debt, there's also a sort of trade-off. So just to give you an example, in Nigeria, for example, the 10-year bond is currently at 11.9% yield, and the 10-year euro bond is at 9.7% yield. In Kenya, it's 12.4 and 9.2 1% ratio. So, I mean, effectively, if you have a choice between the two asset classes, Eurobonds in many cases probably offer a better return when you adjust for liquidity and potential convertibility risk. It's also a bit complicated to hedge African fixed income exposure. I mean, in some markets, actually, NDFs are relatively liquid. Take the case of Nigeria, for example, or hedging is not that expensive in the big scheme of things in South Africa. But very often you end up in a situation where NDF yields really shoot up, and then during market stress, and then basically if you hedge, you have nothing left in terms of carry. Nigeria has actually a good mechanism to hedge via the futures market, but it's naira settled. So in other words, you still get naira at the end of the day, and you have to source dollars, which could be problematic when oil prices are low and there is pressure on the reserves. But that said, that doesn't mean that there won't be opportunities for foreign investors. I think there could be tactical opportunities. I just mentioned, very good rent-free points in South Africa in long-dated bonds during the last few weeks around the Weekby exclusion. Also, if you remember what happened in 2008, 2009, it's a bit of a similar pattern. When you have a massive shock like that, generally central banks cut rates, yields move significantly lower, but then as the exchange rate comes under pressure, eventually you have a reversal of this cycle, not only on the policy rate side, but also on the yield side. And as rates rise significantly, sometimes to 20%, even more, you'll see foreign investors coming back, assuming that risk conditions have improved. Now, obviously, if you're a local investor, I think in some cases, you're basically in a sort of captive market where maybe your ability to invest offshore is actually limited in terms of how much you can do, according to existing regulations. It's not the case everywhere. For example, in South Africa, institutional investors can invest, I think, 30% offshore, plus they have a 10% allowance for Africa. In Kenya, pension funds can invest, I think, 15% offshore. In Nigeria, much less so. I think it's 5%, assuming that the assets bought are actually issued by Nigerian entities, so it's more problematic. But we could see some degree of cross-regional trades. I mean, we have seen that basically. For example, East Africa is an interesting example. Sometimes you see Kenyan institutional investors getting involved in Tanzania or Uganda, or Ugandan institutional investors doing the same, depending on yield differentials and so on, and FX differentials, I guess. Although obviously most of their investments are still held offshore or onshore. Then I think you need to factor in, whether actually your mark-to-market positioning will have an impact on your fixed income holdings. Now, obviously, in many places in Africa, investors still don't mark-to-market, which actually makes it much easier. In this case, you can just hold bonds and really not care that much if you have a sort of medium-term view. But if you buy bonds at relatively low yields, while there is a risk that they back up in the longer run, and you have to mark-to-market, that could be a bit of a problem. I think what's important also is what is your benchmark if you're a pension fund. So if you benchmark against inflation and you have bond yields virtually actually below inflation levels across most of the curve in Nigeria, just to give an example, you could be in a situation where basically the savings of your investor base erodes. That's a bit of a concern, but maybe you don't have a choice and you still have to invest in these securities. I think what's also important, I think, is to keep an eye on the shape of the curve if you're a local investor. It's true that some curves move in parallel in many of these countries, but actually you could have situations where the curve is very steep. So, for example, the long end gives you a massive yield pickup versus the short end, which is the case, for example, in South Africa or Tanzania, at the moment. And generally, you could argue that over time there should be some degree of normalization, or you could have situations where the curve is very steep because the market is pricing or expecting significant policy easing beyond what has already done, and maybe that won't happen, or there will be a reversal, in which case you have to position accordingly as well. I think finally, you probably also need to keep an eye on issuance risk down the line, because so far, we have already seen some countries indicating that they would raise, they would increase the size of their fixed income auctions. So it's starting in South Africa next week. Nigeria is seeking to issue an extra 850 billion naira in 2020, beyond the 745 that was initially in the budget. So obviously, all these will probably at some point put pressure on rates. And again, maybe you want to be opportunistic if you're a local investor and wait until this higher supply is digested to enter at higher yields if that happens. So I'll probably stop here. I mean, there's a lot of things to talk about, but obviously we're time deprived, and maybe we can touch some of these points in the Q&A.
Yes, absolutely, Samir. Thank you so much for this great overview. Now on to Abi. I think the audience can start asking questions using the Q&A or the chat panel. Just as a reminder, Abi is the head of fixed income and currencies with MCB, and he actually manages the African Domestic Bond Fund. On to you, Abi.
Thanks, Guy. Hello, everybody. We can move to the next slide, please. So Samir actually gave a pretty good outline of individual capital markets across Africa, and what we've done over here is we're going to try to make you focus on Africa as one index, which is pretty diversified itself. So you're not investing. We're not talking about investing in individual country markets, which is very problematic itself. But what the AFDB, AFME, and us have done is we've created a fund which provides you access to 8 countries in Africa, and you're getting access to 8 countries in Africa through one vehicle, and 8 countries are very diversified in itself. So you've got South Africa, you've got oil exporters like Nigeria, importers like Egypt, pretty well diversified countries in Kenya, South Africa. And this is what I talked through about how they don't, I mean, there is risk, but there's more perceived risk, and the diversification itself adds a lot of value. So if you go to the next slide, and I've got 7 slides in this. I'll quickly go through this so we can go to Q&A also. Yes, so just quickly, this is, it's a bit busy, but sorry about that. But this is me charting out performance of African local currency bonds, which is the index that Albin talked about, versus peers for the last 5 years. So you've got emerging market hard currency bonds, African hard currency bonds, Euro bonds, EM local currency, US high yield, US investment grade, and US treasuries. I mean, might surprise a few, did surprise me when I did this, but over the last 5 years, African local currency bonds have outperformed everybody else on that list. The total return on that index is 25.32% in dollars. The next closest that comes to us is US investment grade, 24.44%. The index doesn't go beyond that, so which is why efforts like creating the index and working with Bloomberg and AFME and creating an ETF are very good, because this gets focused on an asset class that didn't exist before. So we're able to actually talk about African local currency bonds in the same breadth as US investment grade, US high yield, and compare and contrast, which didn't exist before. So the table on the left shows the total return since then. The table on the bottom right is the same numbers, but just annualized. So instead of 25% in dollars for 5 years, it basically shows you that you're making 4.6% per year. Next slide, please. And this has come, this 5-year return that I talked about, and outperformance has come in what I call a business as usual, which is FX depreciations across the board in South Africa, Egypt, Zambia, and all that. So we've given 25% in dollar terms over 5 years, beaten the peers, while FX has depreciated across the board. If you go to the next slide, please. And this is my favorite slide. I love this slide. This is what brings the two things together. So using the fund and the index, you're not getting exposed to only FX. You're getting exposed to obviously bonds and FX. So what this slide does is we've taken data for the last 3 years from the index. You've got in the gray bar, you've got returns from the local currency bond markets for each of these 8 countries that are in the index. The red bars are the returns from their FX. This is analyzed. So 3-year data analyzed over 3 years. And the sum of that, which is what I've circled in yellow, is the sum that you get from these bond markets in dollar terms. What I find interesting is that over 3 years, which is 2016, 2019, not a single country in Africa gave negative returns in dollar terms from their local currency bond markets. This is not hedged or anything, so this is all unhedged returns. This includes countries like Zambia, which over 3 years lost 10% on an annualized basis in the FX. But the local currency bond markets were up around 16% in annualized. So you're getting 5.73% in dollar terms on an annualized basis over 3 years. This is what leads to the 5-year performance outperformance that we saw. If you go to the next slide, please. So that was all 5-year data. Talking about the coronavirus time, this is basically year-to-date numbers. Again, sorry, busy slide, but what we're trying to show over here is that over a 5-year period, we saw outperformance from the local currency bond versus peers such as US investment grade and all. In a time of extreme stress and volatility, which is the last one this year, especially March, the asset class has also outperformed peers. I mean, not everybody, but if you look at the tables on the bottom, which basically give color on the graph on top. So Africa local currency was down minus 4.46% in dollar terms year to date, and that is up to May 11th. At the same time, Eurobonds, African hard currency, was down 15% in dollar terms. So yes, Eurobonds are more liquid and all, but they are also higher beta than essentially because you're getting a lot of. Well, I'll get to that. Why local currency does better is essentially because you're getting a rate cut effect across central banks in Africa, which doesn't translate necessarily in African hard currency bonds. So again, we are down minus 4.46%, but significantly lower versus peers. I mean, the only ones that beat us during this time period was U.S. government bonds, which gave a positive return, and U.S. investment grade, which was down only 0.5%. Max drawdown is a number that investors love to see. So during this time period, drawdown essentially tries to. Sorry, previous slide, please. Drawdown just talks about that's the graph on the bottom right. Previous slide, please. Previous slide, please. Yes, please. Yes. So drawdown is what shows what the maximum fall in that asset class was during that period before it started recovering. So essentially, for the year to date, African local currency lost 15% at a stretch. African hard currency was down 30%, Eurobonds. The S&P 500 was down 34%. So again, drawdown is a measure of volatility and pain. But again, on that, so on a total return basis and performance basis, we're pretty much at the top 3, of our peers, and on a volatility basis, also around there. So the last slide, please, if you go to the next one. I'll quickly talk about that. I'll leave it over here. So this is basically just, I'll put this chart up and we can go to Q&A, but this is the fund itself. This is the NAV of the fund since launch, which was September 18th, 2018. The fund aims to track the index that we've talked about. It is listed in Mauritius, domiciled in Mauritius, trades in dollars, and pays dividends in dollars. The 3 circles in red you see over there are the 3 times that the fund has paid a dividend. The dividend yield from the last dividend, which was in April 2020, came to around 12.22% on a dividend yield basis. So yeah, that's it from me about the asset class, and happy to take questions.
Thank you, Abi. Now we're going to turn to the Q&A session. We have 20 minutes, and allow me to quickly start with Marine. Marine, can you please tell us about your investors' response or their feedback towards investing in local currency bonds during this crisis, this time of uncertainty, and also some of the some of the actions that you have in the works for your local currency projects under management, and most notably, of course, the African Development Bond Fund. Mary?
Yes, hi everyone. So in terms of response from our investors, so as Abby and Alba mentioned before, so the African Domestic Bond Fund is structured as an exchange traded fund. So it's listed on the exchange in Mauritius and it provides daily liquidity. So this fund, being an ETF, is available to both retail and institutional investors, but we have around 90% of investors that are institutional. So mostly DFIs, banks, pension funds, reinsurance companies, and asset managers. Since the beginning of the crisis, despite all the uncertainty and high volatility, we didn't get a lot of redemptions, actually. Only around less than 5% of the fund, of the AUM of the fund. As Abby mentioned, the fund pays semi-annual dividends. The last one was actually paid, was declared in April, but paid this week, I believe. So yeah, like most asset classes around the globe, we didn't receive a lot of interest for new investment in the fund in the past 2 months. However, we didn't get redemption requests either. So which is a good sign. Most of our investors are looking at a more medium to long-term investment. So for the moment, they are still resilient and still staying with us. In terms of actions and measures that we are taking, before the crisis, we were working with our colleagues from the African Development Bank. We were looking at dual listing the fund on several exchanges across the continent. So we were in discussion with the Botswana Stock Exchange to list the fund over there in Pula. And we were also in discussion with the Nigerian Stock Exchange to list the fund in Naira. Why dual listing the fund? It's in order to facilitate access to this asset class for local investors, providing an option for institutional investors that have a limited allocation for offshore investment. So by listing it locally, it provides them with another option. And by introducing a new product on those markets, we are also working towards the development of local financial markets. So that was the main initiative we were working on. Of course, for now it's been put on hold, but we are still considering it and still working towards making it happen. And last point, we are also considering the setting up of a UCITS vehicle in order to facilitate access for European investors who are looking at diversification options. That might be in the longer term.
Okay, thank you. I think the cross-listing is really important. So you talked about Botswana and Nigeria, and that's really good. I have a question for Samir. Samir, a lot of countries have put in place expansionary monetary policies due to the COVID crisis. How these policies are affecting African the yield and curves in African capital markets?
Yeah, that's an interesting question. I think in a number of markets we have seen curves both steepen. So in other words, the short end of the curve, T-bills, so short-dated bonds, outperformed, and the spread between the short end and the long end of the curve widened on the back of this round of easing. So I mean, you know, South Africa is a clear example, you know, where obviously the SARB cut significantly recently. The curve was already steep, but steepened even further on the back of that. Obviously, as the central banks are easing and the short end rallies, there's also probably pressure on the long end of the curve because of expected supply pressure. But I must say that, it's not really, the same has happened in East Africa as well, I would say in Kenya and Uganda. So probably steeper curves, or we will see steeper curves in the coming weeks. But it's probably not been uniform. If you look at Nigeria, for example, depending on where you start the curve, but if you use automobile yields, I would say that the curve is probably roughly flattish or thereabout. Still, obviously, it's quite steep if you use the government treasury T-bills as a starting point, but that's more because there's no supply there. In Egypt as well, I think the curve is actually relatively flattish. It's slightly steep, but certainly, there was initially a sort of overreaction where the short end rallied when the CB cut, and in recent weeks we have seen T-bill yields actually rise faster than bond rates. But generally, I would say curves are lower, if not steeper, and certainly we haven't seen any sort of disorderly pressure on rates in recent weeks, perhaps to some extent in March, and that's maybe because African currencies have somewhat stabilized over the last few weeks.
Okay, thank you. So can I just have a follow-up question for you, Samir, about basically some of the central bank's responses? It's a question from Akin Adigun. So I think you probably have like a magic ball. So here's the question. In your view, what should be the best response of African central banks to spur recoveries in performance of asset classes, whether bonds, equities, or other alternative asset classes in the COVID and post-COVID period? And also if Abi wants to jump in, but I think Samir could answer or provide some inputs to this question.
Yeah, I think, we can look back at what happened in 2008, 2009. If anything, it could be, an education for what's to come. Back then, as now, we saw very significant easing by African central banks to support their economies. And rates actually declined to much lower levels than now, if I remember correctly. You might remember that the Nigerian 20-year bond at some point printed at 7% yield. I think it was in 2010. Well, and to some extent, we'll see this easing and liquidity support rates onshore. It could well be that even part of this liquidity also, is channeled into the equity market. The worry is always that down the line, if there's too much liquidity onshore, eventually exchange rates will come under pressure, especially because this time we'll have significant fundamental shocks to the economy in terms of exports, in terms of remittances, tourism receipts, and so on. So if the exchange rate comes under pressure, much more than what we saw until now, eventually this easing cycle and yield downside or low, relatively subdued yield environment will have to reverse, and that's the worry. It might not necessarily be a concern for all domestic investors because not all of them mark to market, but some of them have to, and they will face significant losses when that inflection point comes. And actually, that inflection point eventually will be a re-entry opportunity for foreign investors who might be on the sidelines for the time being.
Yes, thank you, Samir. I have a question for Abi. I think he is also answering this question online. What are some of the potential issues you face while managing the fund? And also this question goes along with Michael Atinjiego's question, who's asking 2 to 3 key issues that are affecting the performance of the local currency bonds.
Sure. So, firstly, it is a relatively new asset class. It is something that DFIs like the African Development Bank are very focused on improving, right? You want countries to have a local capital market, local currency bond market, rather than be forced to borrow in dollar bonds all the time. And a lot of the countries that are facing problems right now are countries that can't really resort to their local currency bond markets right now. They are beholden to the dollar bonds that they've issued and got, and the lenders that are doing over there. If you had a strong local currency bond market, you could do much more. So this is something that is relatively new in Africa. So with a new asset class, there are certain teething pains, which are the one or two issues that I would highlight, which is essentially liquidity. Obviously, relatively isn't as good as other asset classes, and you won't expect it to be as good as the US bond market or the European bond market. It is significantly lower, but also the amounts invested in this asset class are significantly lower. So for example, our fund is around $26 million. For that size, we haven't faced any problems in terms of liquidity because we are still a tiny drop in the market in terms of investing in the bond market. Nigeria is probably the problem child that everybody mentions in terms of liquidity right now. But the Nigerian FX used to trade $450 million a day, now trades around $50 million a day. It's still hard, but given the bond fund that we haven't faced the size. And we think up to a $300 to a $400 million size for the fund, we don't expect to see issues even in times of crisis like this. So liquidity is definitely one thing. Transaction costs are still very high for bonds in these markets, but all these things that I'm highlighting are just teething pains. And we think as the asset class matures, they'll just slowly start getting better and better. The bond market will become more liquid, transaction costs will go down, and this is where initiatives like what AFME and AFDB and the fund are doing are to address issues like this, to make it into a robust asset class and remove the issues.
Okay, thank you, Abi. Let me turn now again to Samir from your strategy with your strategy hat. I have a question from Mark Kamugish. Sorry, Mark. His question is: given the underlying market conditions, poor liquidity and convertibility, is indexing a suitable approach? I think you could provide your viewpoints on this question, Samir.
Okay, by indexing, do we mean buying the index of bonds rather than country-specific bonds? Or
yes, I think it's in terms of indexing, by buying indexes.
Passive versus active, I think, if I'm not mistaken.
Yeah, I think that's probably actually a good approach, because then you avoid this onshore FX convertibility or FX risk or even fixed income liquidity bottlenecks while you have an underlying asset. Actually, it's something that you could even do, on the FX side. For example, if you were able to buy a basket of NDFs tracking country-specific NDF performance. But the situation varies, obviously, because some markets will have very attractive tactical opportunities from time to time. So the way it happened in South Africa of the last couple of weeks, then perhaps to optimize performance, you have to be involved. Now, obviously, at the same time, you don't want to buy bonds in countries where rates are still too low relative to equilibrium, and where perhaps there could be further FX pressures. So I think you have to balance the two.
Guy, I can also add to this. It's an interesting question that we've been asked a few times in the past. Now, indexing for this index, which is Pan Africa, to me at least, it doesn't really matter if it's passive or active, because nobody has this index in their asset allocation right now. So the minute you're allocating to this ETF, even if it's passively managed or actively managed, you are making an active bet, regardless of who you are. We would love this for this index to be in asset allocations, and then we can have the debate about passive or active. But this ETF essentially, or this index, will be an active allocation, and how this does is going to be an active bet for any investor out there. But the good thing it does is it allows you to access this asset class in a very easy, very liquid, very transparent manner, which you wouldn't be able to do if you were doing on your own. If somebody had to buy all the bonds in the index, well, not all the bonds, but to track the index, they would have to set up custody relationships, custody accounts in every country. They would have to have broker relationships in every country, which is what we do. And so with a click of one button, you can buy shares in the ETF and you get access to all these markets through one share.
Thank you, Abi, and thank you, Samir. I have a question for Alben. Alben, this is a question from Evans Osano. What's the cause of the dip in outstanding debt in 2016? How complete is the data? And also, if you can answer the question from Eduardo Jitahi, who's asking what's the impact on taxation on the returns of African bonds, and also to what extent does the restrictions on repatriating capital diminish the attractiveness of African local currency bonds?
Okay, thanks, Guy. So for Evan's question, so yeah, indeed, we had a drop in the 2016 local currency amount outstanding. And this is mainly on the back of two issues. This is FX related, actually. So in 2016, I think the Central Bank of Egypt moved from a managed float to a free float. And shortly after this decision, actually, the Egyptian pound dropped by 30%. And also in Nigeria, I think we had 30% devaluation. I think at the time, the CBN brought down the peg. So because those two countries actually are two of the largest countries in terms of amount outstanding, so that justifies the drop when you convert everything in USD. The second question was from, sorry.
The second question is from Edouard Jitahi. He's asking the impact on taxation on the returns, and also to what extent does the restriction on capital repatriation diminish the attractiveness of local currency bonds?
Sure. So when you think about that, when you're an offshore investor and you invest in African local currency bond markets, so you realize your gains on the fixed income side. And when you want to actually exit, in the past, we had some situations where offshore investors had actually to queue at the central banks to get their dollars and exit the country. So that's where, from the discussions with the offshore investors that we have, it's a challenge on the attractiveness of African local currency. And in terms of taxation, so in some countries, we have what we call withholding tax on coupons. So essentially, this tax is actually kind of eating your returns and can also reduce the attractiveness for investors.
Thank you, Alben. Quick final questions to all of you. What's your outlook for the asset class going forward? Let's start with Abi, and then Samir will provide some inputs before Alben will close the round.
Sure. Actually, I think Oliver asked that question, and I was just writing to him, so I'll just voice it out. I mean, we've shown that over the last 5 years, at least on a long-term basis, African local currency has given positive returns in dollar terms, despite FX depreciation, and has beaten global peers like US high yield and US investment grade bonds. That has primarily come because yields have been very high and inflation has been falling, so central banks have been cutting rates. There is nothing that I see changing that dynamic in the future. Inflation is still falling across the board. There are still relatively high yields across the board. Maybe in some countries not for a temporary period, but then real high yields become permanent. So central banks are cutting rates. And more than that, we think the US dollar is one of the most overvalued currencies in the world. If it starts to fall, as the US is trying to depreciate the currency, but they keep falling, and COVID crises like this get a safe haven bit to the US dollar. But once it's business as usual, the US dollar will fall, which will only add to returns of this index. But if you don't believe me and you think the dollar keeps going up, over the last 5 years, the dollar has been going up and the asset class has been performing very well.
Thank you. Abi, Samir, what's your outlook on the markets?
Yes, I think for the time being, so over the next few months or so, domestic investors probably will drive performance because obviously most of them either don't have to mark to market or don't care about FX risk as foreign investors would. We will eventually, over time, see a return of foreign investors, but I think it will require an improvement in risk conditions. I mean, for the time being, EM local currency debt funds are still facing redemptions. It will also require lower Eurobond yields for an investment in onshore debt to make more sense. And I think we'll see possibly at some point rates in some African countries rise from current levels if the exchange rate comes under pressure. And that could be tactical regulatory points that some foreign investors will probably try to take advantage of. But overall, I think the performance as of now will probably remain decent. It's just that there will be perceived FX convertibility or exchange rate risks from an offshore perspective.
Thank you, Samir. Albert, do you want to provide your outlook of the market, and also can you provide some insights as to the trust fund that the AFDB has put in place?
Okay, thanks. So I won't comment on the outlook, but I think I'll focus on the relevance of local currency bond markets in this environment, because what we believe is that our countries actually may face actually sharp increases in their fiscal and current account deficits. And really, when you look actually at the external financing conditions, they are not as supportive as they were a few years ago. So definitely, part of the response would have to come from our domestic investors and our domestic bond markets. So for that, actually, I echo what Samir was saying. So the trust fund actually, so it's something that we're really excited about. We launched it this year. It's going to be actually funded through two main donors, so Luxembourg and Netherlands, and actually to generate impacts for the first phase, we will be actually focusing on the West Africa region.
Thank you, Albert. We are 3 minutes past the top of the hour. This is the end of our webinar. Maybe final words from our panelists, if you want to say a couple of words on how business practice will change and how the capital markets will change as a result of the current crisis. Just in a minute, the final round for Abi, Samir, and if Albert wants to jump in also.
I mean, I think initiatives like this are obviously a very good move, as I've highlighted before. We need countries to be more self-dependent. For that, they need to have local currency bond markets, which leads to a lot more of other things, which is local currency corporate bond markets, which leads to innovation happening. Companies can raise cash locally. So there's a lot of benefits of that. So far, we haven't had a fund or the like which allowed foreign investors to access this market. And this is one that was launched 1.5 years back. And we hope others follow soon also. And this garners more assets that go into asset classes like this. Historically, people have looked at Africa with a much more risk perception. And we think perception is much different than reality. Hopefully, the numbers that we've shown, the facts have shown that. So hopefully that gets people more comfort to allocate to an asset class like this, which is growing. And like I said, we'll have teething pains as it grows, but it'll grow very fast. So we remain very bullish, and we're obviously here to answer more questions after this if anybody has. I think my details will be there. And Guy, somebody asked the questions on how the slides will be shared, so maybe we can have information on that also.
Absolutely. We'll share the slides through email. Every participant will receive an email within a day or two. We'll be able to download the presentations and even the recording of this presentation. Yes, and I'll make the announcement at the end of this of the session. Samir, do you want to?
Yeah, I mean, actually, I think we've come a long way. I mean, if you remember, 15 years ago, you couldn't even get a secondary market bond quote on Bloomberg or Reuters for most African countries. And now, you know, there's pricing. You have platforms where you can actually see where the bonds are. There's been a lot of reforms in select countries to actually boost secondary market liquidity. It might not necessarily be, you know, as great as one would expect, but certainly there is two-way pricing now in many places. And I think these reforms need to continue, right? We need to have active primary dealers, platforms that allow liquid markets to operate efficiently and so on. Actually, African local markets, I think, have become more visible internationally. I mean, there was a time when, you know, very few people would get involved in these markets because maybe they were not aware or they thought that the risks were extreme. And the risks are there. I mean, from time to time, we have these convertibility issues or exchange rates depreciate significantly and so on. But the returns probably over time will compensate for it. Perhaps lastly, I think what's important is also index inclusion for a number of frontier African markets. I think, look, the liquidity threshold has probably not been met yet. In fact, some countries, such as Nigeria, for example, were part of the GBIEM, then were removed because of convertibility issues in 2015. But actually, from a tradability on the fixed income side, you know, for example, Nigeria is a market that should be in the index. I think very unfortunate that it was removed in 2015. South Africa is still part of the GBIEM, but unfortunately was removed from the WIGBI index. However, you have a country like Egypt, which actually had one bond part of the GBIEM until 2011, which is trying to make its debt market euro clearable, so to ease foreign investor access and also to reintegrate the indices. I think mainly the GBIEM. So, you know, these sort of initiatives in terms of index inclusion probably will help, because then you have a sticky foreign investor base involved in your bonds. They might be underweight at times, but there will always be some degree of exposure.
Thank you, Samir. Thank you to all of our panelists, all of our speakers for today's webinar. And thank you also to our audience for attending today's webinar as well. Next week, we'll host another webinar on capital markets, so a broader subject. So please stay tuned. I think it's going to be on May 19th. If you have any questions, or if some of your questions haven't been answered today, please contact us, and we'll be happy to forward your question to the speakers. Once the webinar ends, you will see a survey on your browser. So please, we'll appreciate if you could complete the survey and provide your feedback. You will also receive a follow-up email within 24 to 48 hours with a link to view a recording of today's webinar, as well as downloading the presentation. On behalf of Making Finance Work for Africa and the African Financial Market Initiative, I would like to thank you all, thank the audience, and thank you also to the speakers once again. Stay safe and be well. Bye-bye. Bye, Aban. Bye, Marine. Bye, Sam.
Bye.
Thank you so much.